Morning all. Welcome to this webinar today where we'll be discussing listed property, choosing wisely in the risky market. My name is Veldin Theron, Head of Institutional Business at Prudential, and joining me today is Yusuf Mowlana, Portfolio Manager on listed property. He also manages some of our institutional equity mandates. We received a lot of questions from our audience and we do thank you for those. They cover a wide array of things, ranging from what are the prospects for listed property, which specific companies are we choosing, etc. I've sought to distill some of those questions and ask them to Yusuf during the course of the webinar today. Just in terms of housekeeping, a few things that I do need to mention to you. Firstly, this is a CPD event. To that extent, we will be forwarding the CPD certificates to you in the course of the next week or two. A link to the recording and a copy of the slides will be sent to you in the next day. And then lastly, we do ask you to ask more questions during the course of the webinar. Encourage you to do it as early as possible and not wait to the end. We have a team behind the scenes that will also help us answer some of the questions, and Yusuf and I will take the remaining questions at the very end. Thanks and feel welcome. I'll get right into the webinar by posing the questions to Yusuf. Yusuf, welcome to you and thanks for your time.
Thanks, Veldin. Thank you. It's good to be here, and thank you to everyone who's dialed in today. We really appreciate your time and look forward to your questions at the end.
Yeah, the audience, they're interested in this bad performing asset for many, many years. They want to know what the prospects are. They want to know which stocks you're picking. But I thought it's maybe appropriate to go back in time a little bit, say over the last 10, 12, even 15 years, and just think about what listed property has done over the longer period. It's not always been a bad asset. For many years, it felt like the asset that can't lose. Would you care to take us through that journey?
Sure. So I mean, you mentioned that it's been a bad asset for many, many years, but really, before that, it was an exceptional asset class. The bull market kicked off, in 2002. And I think what precipitated that was, South Africa came off relatively high interest rates, which meant that, with high interest rates, development activity slowed down quite a lot. But interest rates bottomed in the early 2000s, and subsequently the South African economy grew very, very sharply. So what we have was, a situation where there was very little new supply on the market in the early 2000s, very strong demand, and what happened was that, rents grew exceptionally. That was sort of quite unique in that I think it almost caught the market off guard, with the lack of new supply. And then, that brought with it, quite a lot of new office development. And unfortunately, towards the latter part of that bull market, which ended at the end of 2017, the economy caught up with property, and you had strong development activity meeting sort of weak demand, and unfortunately, what you've subsequently seen is the effects of that, in terms of negative rent reversions, etc., and higher vacancies. But during that period, I think what sort of put the bull market on steroids was that companies were able to use their high valuations to raise equity quite cheaply and buy assets and develop assets as well. And so that saw, quite a lot of strong earnings growth. But, with company valuations trading below where the physical property valuations are, that game could no longer be played. And you see that in this graph. So, at the end of 2017, the market for the best part of a decade and a half had returned 22.5% per annum, and since then we've seen the market decline by nearly 1/3 every year, so just under 28% per annum decline, which is quite something indeed.
That begs the question, Yusuf, that fall that we've seen, significant fall from the start of 2018, end of 2017. I mean, we got used to property being somewhere between bonds and equity in terms of expected risk and return. what has changed to the asset class from a fundamental perspective, would you say then?
I think maybe there was a perception of defensiveness, but with the bull market came really good predictability of earnings because landlords could have sight over what the vacancies were doing. They knew that tenants were going to remain in place. The escalations were being met, and so like clockwork, one could predict those earnings. And you can see in this graph, which shows the delivered dividend per share in the JSAPI, which is the South African Listed Property Index. From let's say 2006 to 2007, the listed property companies were actually able to deliver earnings growth in excess of what the SouthSide expected. So maybe just to help you read this candlestick graph, the long lines represent the top and bottom estimates of the SouthSide. And then, the big shaded blocks, the second and third quartiles. And you can see in 2006 and 2007, the delivered return dividends were far in excess of, at the top end of what expectations were. There was a bit of a wobble in 2008 and 2009, but you can see that from 2012 onwards, there was relative certainty over that income. But, subsequently in 2017 and onwards, the companies failed to deliver what the SouthSide were expecting. And so I think that, probably, disrupted that clockwork nature of the earnings delivery. Also, I think what one would expect, you quite rightly point out that many people thought of the asset class as sitting somewhere between bonds and equity and expecting a return, commensurate with that kind of payoff. But what you've put together is just a framework for how we think about these property stocks. So some of them have very low levels of leverage, which means lower levels of risk. Others have very high levels of leverage, which increases your risk. And then similarly for tenant risk, one would much rather have, let's say, a grocer, in your property than, let's say, a department store retailer. And then I think, property obsolescence risk is quite an important part of the way that we look at property companies. So, what we've seen especially in offshore markets is that big shopping centers, there's a risk of obsolescence in that online retail is taking market share very rapidly now. And so, those properties would have a higher risk of obsolescence. And so I think to the extent that you have a property with low risk of obsolescence, such as a residential apartment, those would probably be, give you returns much more commensurate with a bond as opposed to an equity. So I think, there is a spectrum of returns and it differs from company to company. One can't really say that the sector as a whole is either equity-like or bond-like. In our market, we have companies that are both corporate bond-like and equity-like in nature.
So with those changes, Yusuf, the bigger differences between company in terms of earnings estimates and earnings growth, different fundamentals in terms of leverage and so forth. I mean, what has that meant for your property process?
So I think, Walden, what we recognized during the market upswing was that these companies were really moving in unison with each other, and you can see that in this particular graph, what we show is the correlation of the property stocks to each other, of the SA market as a whole, the individual stocks to each other, and also the resources sector. And you can see that, for the most part, property tends to have a higher correlation to each other. So the individual property stocks exhibit a higher correlation to each other than the average market. And, so during the bull market, we see quite elevated levels of correlation. But with the bear market, with company performance diverging quite significantly, those correlations have definitely come down. And at the end, you'll see, an increase in correlation because, everything fell together. But yeah, we think the earnings will be quite divergent. So we've decided to adopt a more active approach in our multi-asset funds. But also we've launched, an active property fund in addition to our existing enhanced index tracking fund. to take advantage of this mispricing.
Perfect. That's a good journey historically, Yusuf, and also talking about how you had to evolve the process over time, which is quite insightful. If we can move to the pain of COVID-19, obviously it's had massive health effects and we're not underestimating that. But from a financial perspective, the sector lost in the order of 45% to the end of March. It recovered somewhat, but it's still down by quite a lot as we stand at the end of August, close to the end of September. I mean, even in a bear market like this, as bad as this bear market, there are always some winners and some losers. Can you maybe talk us through which those were?
So I think, the losers were, I think anyone who's sitting at home and thinking about the activities during COVID would realize that they've probably gone to the shopping center far less. They may have used online retail for groceries for maybe the first time, or they've become a regular user after experimenting with it. And you can see from the returns in the index that the worst returning companies for the year, especially among the top stocks, are Vukile Property Fund, Redefined Properties, and Hyprop Investments. So those particular companies did have relatively elevated levels of debt before COVID, and also quite a bit of offshore debt. So with the rand depreciating as it has, the rand value of the euro debt has gone up, and also they are retail heavy. So they have quite a lot of exposure to retail assets, and so they've been caught in the eye of the storm, and you can see that they've been the worst affected. Conversely, on the better returning companies such as Investec Australia Property Fund and Sirius Real Estate are both offshore plays. So Investec Australia, it's obviously in Australia. It has no retail exposure. Sirius Real Estate similarly has no retail exposure, as in Germany. And then the rest, for various reasons are down, but to a lesser extent than the worst performers. But there's a clear divergence in the earnings and also in the balance sheet strength of these companies. So one that's explained by those factors.
So, I mean, the audience alluded to many of those bad factors, and they're talking about things they can see obviously for themselves: the empty shopping malls, work from home, empty office spaces. And this is even pre-COVID. If you go to places like Sandton, Rosebank, a lot of development over the years and, office oversupply. With all the bad news, I mean, I presume there's still caution required in certain sectors.
So I think you're absolutely right, Valden. With office vacancies, having increased over the years, Growthpoint reported recently, and I think their office vacancies went up quite a few percentage points. And I think with vacancies going, quite high, that automatically should mean that asking rents should decline. And you can see there's a very clear relationship. So I'd like to point you to the slide on display at the moment. You can see in 2003, vacancy levels in the office sector, reached about 15%. And then, the asking rental growth was pretty much close to zero, and that would have been below inflation. And with vacancy rates coming down fairly significantly in South Africa's period of strong growth, you can see the inverse relationship with asking rentals. So rents were able to grow. So the number that landlords were able to ask for, they were in a fairly good position because vacancies were low. They were able to ask for decent rents. And that slowly has now declined. So we think for perhaps a number of years, that might be the case. Though if there is any good news to come out of all of this, is that development activity in the office sector has slowed very dramatically, such that only about 1% of office stock is currently being developed. And so to the extent that is maintained over a number of years, you could see rents at least stabilize in 3 or 4 years' time. But until then, I think it will be tough. And I think for large shopping centers, for a number of years, a shopping center was the place to go with your family. And those super regionals and regionals did very well because families, were able to go there on the weekend and dine and go out to the restaurant and the movies. But I think, even before COVID, we were seeing, slowing trading density growth for those particular sort of retail formats. And I think, COVID may affect that even further. But yeah, there are, other retail formats which are doing well. So convenience, conversely, has done very well. Convenience retail and some niche sectors have done quite well. But I think we are cautious on larger shopping centres and the South African office sector in particular.
If I can maybe just circle back to a previous point that you made on debt levels in property companies taking on more debt to grow their earnings, to buy offshore companies. I mean, there was a specific question about debt levels. Let me ask it to you rather than specifically in general. Can you explain leverage, the concept of it, and how it could potentially be a bad thing in a down cycle?
Sure. So leverage can both enhance returns and detract from returns. And property is sort of unique in that, well, it was not unique, but there are other sort of stable sectors where one can predict the income, and so naturally people then take a stable asset and want to lever it to get enhanced returns. So I think perhaps below 30% loan to value ratio. So we speak about a loan to value ratio. We're saying the value of the outstanding loans to the bank versus the value of the property. We regard anything below 30% as being very, very safe. Between 30 and 40% is probably still okay. And then, once you start getting beyond a certain level, perhaps 40 to 45%, it becomes, perhaps a bit more risky. So on the graph that you see in front of you, we have, just a theoretical property company. So using the vertical axis for equity value, at a 0% loan to value ratio for a theoretical asset of 100 Rand, if you have no debt against that property, your equity value is 100. And then just moving down the line, if you went to the bank and borrowed 30% of the value of the property, your bank debt would be 30, your equity value would be 70. And then, there is a linear relationship as you move down, but there does come a point where, borrowing beyond a certain point, becomes very risky in that, a small increase in your loan to value ratio, which can be precipitated by a lower valuation, would lead you to become a forced seller. And we've seen this happen, countless times over the property cycle, that companies in trouble are forced to sell assets below their fair value. And so then you see that, your equity value declines very substantially because you take an asset that you thought was worth 100 and then end up selling it for 80. And you find that your equity value just evaporates without doing anything. And Into is perhaps a good example. So it's a company that we haven't owned in our funds. And before the company went into administration, so effectively went, declared that it's bankrupt. There was still a positive net asset value to the company, yet it's almost unlikely that shareholders will get much or will get even a fraction of that net asset value. So I think we are very careful on leverage, especially given what will be a tough valuation cycle. So valuations will most likely go down over the next number of years.
Talking about valuations, despite the bad news, there's the old adage that good valuations don't come with good news. They typically come with bad news. But looking at valuations, and a lot of people are of the opinion they're attractive. In many ways, that's the hook to our webinar. We're talking about risky market, but we're also implying there's cheapness in the market. Forward distribution yields are above bond yields, and previous webinars spoke about bond yields being high in their own right. Why do you think the market is simply not biting at this value, or at least nibbling?
So I think, in reality, there's no near-term catalyst. There's no silver bullet that will just fix the sector. Property does tend to be a lagging sector in that what we see today, in terms of the tough market today, will only materialize in lower rents maybe in 2-3 years' time, because leases, we have leases in place for let's say 3 or 4 years, And once those expire, they'll only expire in 3 or 4 years at the market rent. So we still have this, this element of over-rentedness in the sector. So I think people are just cautious on what the income can do, and also what the loan to value, the real loan to value ratios are, because we've only just begun to see the decline in valuation. So I think those are perhaps two aspects. Property companies are cutting dividends, and everyone loves a growing dividend rather than a shrinking one. So that is another factor weighing on the sector. But I think what we do observe, is that property trades at a big discount to its replacement cost, and being a capital intensive sector, to the extent that the properties aren't obsolete. We think that's probably a good time to begin looking at these properties, because at some stage, if they need to be replaced, you're buying properties below what it would cost to replace them, and that automatically means that rents may need to go up versus the replacement cost.
Yusuf, I'm going to put you on the spot, so fair warning. A popular question, in fact, the most popular question was what your expectations would be for the sector from a return perspective. I know we avoid making forecasts typically as Prudential, but given the valuations, given the risks, are you willing to take a stab at that?
Sure. So I think with many companies cutting their dividends to a level that's much closer to free cash flow, that's arguably quite a good thing. But if we're sort of observing a dividend yield 1 year ahead of about 12%, which is quite attractive. It is above the 10-year bond yield. And then if you look to the forecast of earnings growth or dividend growth, there is quite robust dividend growth, because companies are moving from a position where they've cut the dividend to the bare bones, and then hopefully would look to increase the payout ratio over time. But I wouldn't pencil in more than low single-digit growth on that number. So one could look at a total return in the mid-teens. But I would be cautious on making any near-term forecasts. But certainly, the number that we're seeing 1 year ahead is far closer to free cash flow than it has ever been for the property sector in a number of years.
Okay, Yusuf, we won't keep you to a specific number.
Okay, thank you.
Although the webinar is being recorded. Let me take you then to where you are possibly more comfortable, and that's company-specific opportunities. You showed a lot of the companies fell a lot post-COVID because of their unique issues. Can you maybe talk in some detail about specific companies where you've increased exposure given the on-sale signs that went up?
Sure. So I think the one of the largest REITs in South Africa is Growthpoint Properties, and that's a company that we were underweight going into this crash, and we've used this opportunity to buy a bit more. And what's interesting about Growthpoint is that they have some very strong offshore subsidiaries and associates which have their own market value, and don't have exposure to any retail, and trade at values that we think are probably below the private market value of the assets. So Growthpoint itself trades at 0.53 times its most recently reported net asset value. But if one removes the listed assets from the share price and also the book value, you're paying about 0.32 times for the Growthpoint SA assets, and that includes a fantastic asset like the waterfront, and then a diversified portfolio of retail and office properties. And we're under no illusions that the sector will be challenged in South Africa for a few years, but at 0.32 times its net asset value, we given the diversified nature of the portfolio and the fact that the company has largely spent money on its assets over a number of years, that seems quite attractive for a very big and liquid stock. Another company that we do like, given the safety of its income, is Equities. So Equities is a pure play logistics company, which has the longest weighted average lease expiry term in the South African sector of about 10 years. So on this chart, you can see that, Equities, we show the weighted average lease expiry term of Equities versus all the other companies in the sector, and it stands out as being way above anything else available, certainly the average. And so that certainty of income we find is attractive, given that we think that the income will grow and the tenants are relatively strong, compared to some of the other tenants that we do see. And then self-storage. So there's one self-storage company, a pure play on the JSE. It's called Storage, but the company doesn't have a very long history. So unfortunately, what we've done is we've used the Bloomberg REIT index, which as you can see, it's the black line. So over a period of 27 years. The Bloomberg REIT index has gone up from an index value of starting of 100 to just under 300, but the self-storage index has gone from a value of 100 to just under 1,200. So, over the long term, there's been substantial outperformance in this asset class, and the properties themselves do have a low level of obsolescence, low obsolescence risk, and also there's very little capex that needs to be spent on these properties. So it does make it an above average asset class, and you can see it in the numbers. Finally, just one company which we wrote about in a recent article, RDI REIT. One can observe that the SouthSide forecast the net asset value to be 153 pence when they report in November, and the share price is 95 pence. But what gives us some confidence is that during the pandemic, Redefined Properties were a holder of about 29% of this company, and they sold it to a real estate private equity group called the Starwood Capital Group. And we think that they are good property investors and sort of understand the assets. And you're able to buy the assets at the same price that they bought it. I mean, these guys are in the business of buying cheap assets like we are, and we think over time the company should be able to unlock value as it disposes of its assets. So I hope that gives you a decent sense of some of the companies that we like and that we've increased our exposure to.
Yusuf, sounds like fantastic opportunities. Maybe before we close, I just wanted to pick up on something you mentioned earlier when you compared a property in relation to bonds and equity. And one of the features you mentioned was tenant risk. Is that something you can maybe unpack for us a little bit?
Sure. So I think it was often underappreciated, when the market was doing quite well, because all tenants were able to pay equally, and there wasn't really a problem where if you had a B or C grade tenant, they were able to pay the rent. But I think what I'd like to highlight, just looking at the slide on your screen at the moment, is that there are significant differences between tenants. So, both of these sets of tenants, which we've put together, are available on the South African, in the South African market. So the first one being Edcon, and we know that Edcon earlier this year went into business rescue. It's subsequently been sold for its parts, but at some stage, Edcon was a big part of the listed property universe's tenants. Massmart, which early on this year, Dion Wired, went into business rescue. The South African government, from what we can see, is that they, the landlords exposed to the South African government do struggle to sign new leases. The government is very demanding in terms of the amount of capital expenditure which the landlords need to spend. One company is exposed to Max Steel, which sells steel products, and clearly, given the downturn in the construction sector, that will be difficult. And then in the UK, department stores have been quite poor tenants. So things like John Lewis, Debenhams, and New Look, which I think South Africans will be familiar with. That's the one set of tenants that one could have in your books. On the other side, you could have defensive tenants like Shoprite, Pick n Pay, Growthpoint Australia has the Australian government on their books as a tenant. One could, instead of having Max Steel, you could have the Bidvest Group. Instead of having John Lewis and Debenhams, you could have Amazon and Tesco in the UK. And then, I would much rather take the risk of, have thousands of small self-storage tenants on the basis that only a handful of them, might struggle, but the majority of them would be able to continue paying rent, and then have, for example, someone like New Look in the portfolio. So I think there are very stark differences. One does need to look at the business model of the tenants quite carefully to understand whether they're doing well, because it's quite seldom that the landlord can do well when the tenant's struggling. It's probably unlikely to happen. So I think it is underappreciated, and something that we do tend to spend a little bit of time on.
So in summary, Yusuf, if we can conclude sort of the pre-submitted questions part of the webinar, it does sound like there are fantastic opportunities to be had, but there's obviously a lot of risk, and you need to do your homework. Any last thoughts that you'd like to leave the audience with?
Well, I think, Valden, what we can observe is that, the notion that property is a defensive asset class has been defeated. It is subject to the overall economy. And I think, in the upcycle, people sort of placed these earnings on high multiples because the perception of the defensiveness was probably, was not correct. It is a capital-intensive asset class. So at the moment, what we're seeing is that the properties traded at a substantial discount to the replacement cost. So to the extent that these properties are not obsolete and that they can earn rentals into the future, it's probably a good time to be looking at the sector, because once things normalize, one would expect at some stage for rents to recover such that a new asset can earn a return on capital. So once if you're buying the assets at a deep replacement cost, at the deep discount to replacement cost, hopefully over time one can see those rentals rise as the market becomes tighter. Of course, that won't happen in the near term, but we try and look further ahead than 1 or 2 years.
Yusuf, thanks for your insights up to now. We received a lot of questions, and we'll be taking them right now.
Thanks, Valden.
Yusuf, the first question we got was from Etienne. You mentioned some of the stocks where you've increased exposure post the COVID sell-off. His specific question is, can you expand a bit from a portfolio management perspective where you're overweight and underweight?
Sure, happy to do that. In fact, we prepared a slide because we thought we might receive this question. I think the slide should be on your screen. And I think what you can see is that, the largest holding is Nepi Rockcastle. And I'll let you read those, as they are on your screen. Secondly, Growthpoint, which is roughly an equal weight versus the benchmark. RGI REIT, as you can observe from the right-hand side, is the largest overweight in the sector. And then that's followed by, Storage Property REIT, which we've told you we think is quite a long-term outperformer, although it's not necessarily optically cheap versus the other available companies. We do think that the level of free cash flow that it provides and the likely growth is attractive. And then Nepi Rockcastle, which is the largest largest company in absolute terms, is also one of the overweights, and that's a dominant Central and Eastern European shopping center REIT. And while shopping center REITs are not necessarily in fashion at the moment, I think we can all observe that online retail has taken quite a bit of market share in developed markets. The company doesn't, or in those particular countries, don't suffer from a huge amount of oversupply of retail space. And unlike the Western European counterparts, there isn't really a high street retail component. So, when one observes the shopping center or retail space per capita, that's quite a low number versus Western Europe. And while we completely do anticipate online retail taking some share, the entertainment aspect of those malls, it still makes it attractive for people to want to visit. Equities Property Fund, the logistics REIT that we're invested in. As mentioned earlier, we like the long weighted average lease period. So the average unexpired lease term is about 10 years, and we like the security that gives to us. And then lastly, SA Corporate Real Estate Fund is a diversified fund, but the office exposure is only about 5% of their total portfolio, and the majority is residential, which we think, well, it's currently going through a bit of a difficult period, but we think those rents adjust to market quite quickly. So the rents that you observe are roughly market rents, and then the industrial, has very low vacancies. I think post this recent disposal, the recent disposals that they've completed, vacancies will be under 1%. So that suggests that it's quite a decent portfolio in terms of attractiveness to its tenants. And then the retail is mostly geared to convenience, and we think that will be a better place to be than larger shopping centers.
Thanks, Yusuf. You made mention earlier in the presentation, and someone picked up on it, the new Prudential Property Fund. You've been running the enhanced the tracker fund for a number of years, and the question essentially is how this new fund compares to the existing fund.
Thanks, Velden. So I think we launched this fund because we saw that property, we were seeing increased levels of mispricing, or at least certainly divergent fundamentals, and we hope to be able to take advantage of that. And I think we've prepared also another slide just to show you the difference between the two property offerings. So in the first instance, the enhanced property index, it takes very, very limited bets versus the benchmark. And the idea is just to provide our investors with the beta of the market and give them the index returns after fees. So we think, I think the slide should be in front of you now. We try and be neutral on sectors, on geographies, and also, try to target the companies with a bit lower leverage than high leverage, and over time, that has added some value to clients. But more recently, our views are that the one can make money from stock picking, and then we look to take more active risk in the Prudential Property Fund.
Okay, maybe some specifics. Please educate me as well, or where to ask the question about REIT status, and the talk about the changes to REIT status.
Right. So I think those of you familiar with South African REITs know that to maintain your SA REIT status, the companies need to pay out about 75% of their accounting earnings. Now, with the stress of COVID, a lot of companies have elected instead to withhold dividends to strengthen their balance sheets. But there is the risk that if they're not able to meet their distribution requirements, and pay out 75% of their earnings, that they fall out of that REIT status. And I think what the companies are waiting for is for the FSCA and the JSE to provide them with some relief in terms of being able to pay out slightly less than the 75% and maintain the REIT status. There isn't yet clarity on that, but I think that will be forthcoming in the next couple of months. But just no clarity as yet, Velden.
Sure. There's a question. Do you think property managers will be re-engineering their office spaces? Are they giving some thought to either downsizing or other alternative strategies?
So in terms of re-engineering the property spaces, we haven't yet seen that. I think companies will probably wait to see how COVID plays out. If it becomes endemic, so if it becomes almost like a normal flu season, then one might need to implement social distancing and barriers in offices, and we have seen some of that offshore, but not necessarily in South Africa. So not yet, but I think we'll have to wait and see.
Yeah. Your view on the platteland? The question is in relation to people being able to work from anywhere, okay. In theory from the platteland as well. Okay. So any thoughts on that?
So I don't think, I think it could work, but I think those of us who have worked from home, we have the rapport with our colleagues because we've spent some time with them in the office.
Yes.
And I think that's that's quite critical, to build company culture, and I don't think one can easily replace that. One could envisage a scenario where people work from home 2 or 3 days a week, as to whether one can work on a farm in the platteland. I think you'll have a very good employer if you can manage that.
Yeah, this is a question that just came through. Why would the SA government not be considered a defensive tenant?
So I think we have to distinguish between the SA government as a guarantor of your SA bond, the SA bonds that you're invested in, and them as a tenant. So I think if you speak to the landlords who do have the government in their portfolio, they have struggled to sign leases on a long-term basis with the government because of the staff changes and the regulations required by the Department of Public Works. So that's quite difficult. And then, often the capital expenditure that's required, for government to sign a long-term lease, it's quite onerous, to the point where, landlords may question whether it's worth spending such a sum of money just in return for a 3-year lease. Because I think what most companies would look for is to spend money and in return obtain a much longer term lease. And then in many of the nodes where government do occupy, they to the extent that they are, they can move, I think they might do that. So I think what we observe is that, banks are reluctant to fund government buildings on a long-term basis because the nature of the leases is quite short-term in nature.
Yeah, this one arguably puts you on the spot, Yusuf. This is the salesman asking the portfolio manager. The question is quite pointed from someone. Why listed property? Why Prudential in particular?
So I think, at Prudential, we do follow, a prudent valuation-driven approach. It is the approach that has led to our clients outperforming over the longer term. And, we'd like to be able to apply that same approach to listed property. And we kind of look to get into the details, looking at the cash flows, looking at the tenant risks, looking at the property risks. And, before COVID, we did undertake, extensive site visits to kick the tires and make sure that we're able to do proper research such that we can do a good job for our clients. So we are very committed, and we'd be very appreciative if our clients continue their support for our listed property portfolios and our other portfolios.
Excellent, Yusuf. I'm going to leave it there. I mean, it's Friday morning after all, approaching 12 o'clock, and at least Cape Townians are quite eager to get out. I'm not sure about people in the rest of the country. Yusuf, I want to thank you for your time in preparing for this. It was really insightful. The audience seems to concur. To the audience, thank you so much for your attention. We know the webinar space is quite contested, all these fireside chats and webinars. So we've had over 400 people dialing in today, a little bit more that registered. We thank you for the support. It's really, really valued. A link to the recording, as I said, will be sent early next week, as well as a copy of the slides. We want all of you to continue supporting us, so be on the lookout for the next webinar somewhere early in October. Have a fantastic weekend, everyone.